Your Lending Era, the podcast where we dive into the world of residential, business and commercial finance, bringing you expert insight, tips and strategies to help you navigate the intricate landscape of lending in Australia. I'm one of your hosts, Jessica, and in today's episode we will be deep diving into alternate entries into the property market, focusing mainly on the first home buyers. However, a lot of these schemes per se do work for non-first home buyers as well. Here with me today, we have Trilogy Funding's Managing Director, David Thomas, and Senior Financial Strategist, Hope Westbury.
Hey, Jess.
Hey, Jess.
Hi, guys. How are we doing today?
Yeah, doing good.
Back for another week.
Back for another week. First home buyers.
Yeah.
How
Something
exciting.
we're very passionate about.
100%.
I love it. Beautiful. Okay, well, let's run through. There's three main areas we're going to be chatting about today. So we'll kick it off with the government guarantees, which a lot of people may have heard over the last few years. It was originally the first home buyer guarantee.
Yep.
Yeah.
FHLDS. Back in the day, it has migrated over to a few different things. But I'm going to pass it over to Hope here, who is our resident specialist.
Thanks, Jess. So the government guarantees are absolute bangers, and there's three of them, as Jess mentioned. Two of them are quite similar for first home buyers, and then there's another one that's a little bit different. So I'll just go through each one so everyone can sort of get a good grasp on what they are and what they do. Okay, so the first one is the first home guarantee, which is very similar to the second one, which is the regional first home buyer guarantee. Now, the first home guarantee, you only need a 5% deposit. You do need to be a first home buyer. There's only 35,000 of these spots available every year. So you do need to get in quick to be able to jump on this one. And it is purchase price and income threshold tested. So you, depending on which area of Australia you live in, there is a table and your broker or lender can go through this with you, but depending on where you live, you won't be able to buy for more than, so in Canberra, for example, it's $750. And as far as income goes, if you're a single applicant, you can't be earning more than $125,000 gross per annum. If you're coupled, then it can't be more than $200,000 per annum.
Okay, so that's pretty reasonable in terms of, what they're trying to achieve here.
Exactly right. It's not too bad. I didn't mention at the start, initially you needed to be an Australian citizen, although for financial year 24, they are changing that to include permanent residents as well. But we just don't know a lot of information around exactly what that looks like. Is it just for Kiwis? Is it for people on visas? We're not sure. But yeah, that's just been announced as of yesterday. So that's super exciting.
Beautiful.
Now, the regional first home guarantee is very similar. The only real difference with this one is that you do need to have been living in that regional area for the preceding 12 months before you apply, or a regional area close to where you do plan to buy. So, for example, I couldn't just decide that I'm going to move out and live regionally and try and get on the scheme. I would have had to have been in that area for 12 months.
Okay, well, that seems reasonable because otherwise everyone would do it,
That's
wouldn't
right.
they?
Yeah, they'd be like, oh, country living, like I'm off. So you can't do that. And there's only 10,000 of these spots available. So
significantly less.
A lot less, but it just ensures that people in those areas get a fair go as well.
Okay.
But as far as the income thresholds and the other things that I mentioned apply exactly to this one as well.
Perfect.
Now, the third one is the family guarantee, and this one is brilliant. So, again, Australian citizen or permanent resident, don't know the exact details around that yet, but they are going to change that for this coming financial year. Now, you only need a 2% deposit. You don't have to be a first home buyer. You can have owned property previously. You need to be a single applicant and be able to verify that you do have a dependent. So again, needs to be a birth certificate of a child that you have, a foster child, and I think you are able to be a legal guardian as well. They've just changed that rule recently. It is income threshold tested again, so you can't be earning more than $125,000 per annum. And the great thing about that is that if you are receiving child support, they actually don't include that in that calculation. So you might be earning $125,000 or less, but if you are earning $10,000 worth of child support every year, that won't be included in the calculation, which is great.
That is good.
And one other thing to take note of with this guarantee is that you do need to be divorced. So if you are separated, that doesn't count, unfortunately. The divorce and the parenting audits and all that fun stuff do need to be finalised before you can be eligible on this guarantee.
Okay, so the dust kind of has to settle. You can't just, separate with someone and 3 months later buy a property.
Exactly right.
Okay. Well, that does seem reasonable, particularly that family home guarantee. That seems like a great entryway back into the property market for a divorcee.
Yes. Yeah, absolutely.
2%, wow. One thing I did actually want to mention here, we got caught with this only a few weeks ago with these government guarantees, is you do need to do your tax returns very promptly.
That's right. You do need to produce this financial year's notice of assessment if you do buy, for example, it's nearly July now.
Yeah.
But the lender will not deem it unconditionally approved until you have supplied the most recent notice of assessment, which is the financial year that we're currently in.
And they don't really give two hoots about kind of your tax due dates. They just won't approve it without it.
Correct.
No, you need to be on the 1st of July standing at your tax agent's door to lodge, so you get your notice of assessment before you need your unconditional approval.
Correct. Yeah, okay, beautiful. Well, those government guarantees are a great incentive, I think, to actually look at buying and really giving people who may not otherwise have resources to get into the market in. Beautiful. Okay, well, on the term guarantor, let's talk a little bit about the family and security guarantor space.
So this is probably important to me because I'm a little bit closer in ages to you guys for being able to actually want to push my kids out of the house and get them out from underneath my roof one day. So how this works is the guarantor is the parent and they can enable their children to use some equity in the family home to get themselves into their first home, right?
Wow.
So when would this be used? Obviously for the purchase of first home, but they can be used for the purchase of a second home. So, for whatever reason, if your adult children are trying to buy their second home and they're falling into lender's mortgage insurance space, this can actually be triggered for the second home.
Yep.
And when do you use it? It's kind of used in any instance whereby the purchaser does not, or the children do not have a 20% deposit to avoid lender's mortgage insurance. This structure enables them to avoid the lender's mortgage insurance with a 10% deposit or a 5% deposit or no deposit.
Yeah.
That's what it's kind of engineered for.
And by bringing in those parents, do we get the benefits of their income as well, or is it purely just equity standpoint?
No. So how the structure actually looks is imagine we're buying a $500,000 home, okay? And what we will do is we will put an 80% loan against that $500,000 house. So it's 80% LVR, $400,000 borrowed there, loan one.
Loan one, yeah.
Loan two, the remaining 20% potentially, secured to that house, but also secured to the parent's home as well.
Okay.
So that's how that kind of comes together. So that'd be the remaining $100,000 that we need borrowed.
Yeah.
Now, the applicant, or the children in this case, adult children, they would be the borrower for both of those loans. All right. The parents are not, going on the loan applications in terms of providing their servicing or their capacity. They're merely saying, I will enable that second loan to be placed and used as security against my home or my asset.
So it is security only, strictly.
Security only. And it can be the owner-occupied home or it can be an investment property that you've got.
Yeah.
So.
Okay, well that's handy to know. Mainly that you can't, bring in mum and dad's income to try and help you buy $1 million property.
No, you can't do that. You must service the debt, but that's also important for the parents as well because the parents don't want to be, thinking that they are taking on more debt. A lot of the parents that do this are in their late 50s, early 60s, sometimes 70s, and their borrowing days are done. You know? So they don't want to be involved in the loan application from a borrowing perspective, but they're happy to go on as a security guarantor.
Okay, and just touching on the ages there, are there any requirements that a guarantor needs to meet to be eligible to do this?
There are a couple of requirements and there's a couple of probably, you'd call them lending preferences, right? So lenders have a preference if the guarantors are still producing an income of some description. So that would be they're either still working or they're receiving some form of superannuation pension, or they're self-funded retirees with their own superannuation funds. They tend to shy away a little bit from, those that are on kind of, old age government pensions and things like that being guarantors. Some lenders will consider, but as a general guide, their preference is to have guarantors that are financially stable in their own right.
Yeah, okay, perfect. And in terms of the legalities and the risks for the guarantor, it sounds like there would have to be some kind of backup plan.
Yeah, so there's two things. So help protect the guarantors, the first dot point is the borrowers can't make any changes to the loan. The agreement is that they're going to enter into this guarantor structure. They're going to make principal and interest payments. Hopefully the property goes up in value. And when we get to an 80% loan to value ratio, the guarantors would be released. Right? So typically for my clients, that takes about 3 years, give or take. I've had some in a year, I've had some in 5, but typically 3 years. The next thing is the guarantors want to make sure from a legal perspective that if they're putting up, as that, the situation before, that $100,000 guarantee, that there's a document behind that is a limited deed of guarantee that limits their guarantee to the $100,000. And that does exist with all lenders. All lenders have a limited deed of guarantee for this guarantor arrangement. So there are some kind of legalities just behind that help protect the guarantors and help them get in and out of this transaction as cleanly as possible.
Okay, so on a summary note, the security or family guarantee guarantor, or one thing, it allows you to purchase a property and avoid paying that lender's mortgage insurance.
Yep.
You can use mum and dad's home, investment property. I think as well from memory you can use sibling and other relations, can't you?
Some lenders will allow siblings, grandparents, aunts and uncles.
Wow, that's pretty generous. It kind of helps most people, if not everybody. Essentially, you'd be looking at, in layman's terms, having two loans, one that's on your house, 100% only secured to your property, and another that is tethered between mum and dad's security and your security.
Correct. That's the normal way that it comes together.
Beautiful. And there are some risks for mum and dad, but generally speaking, there's a lot of protection in place from the banks and serviceability requirements that the applicants, or in this case borrowers and children per se, have to be able to meet before they would be approved for this kind of funding anywho.
Correct. They've got to be able to support the borrowings on their own,
yep.
and they've got to be able to show that they can clear the debt within a reasonable period of time to release the guarantors.
Okay, pretty common sense stuff then.
It is. And a lot of my clients' parents say to me, Hope, we don't want to lose our house. And a lot of these people have unencumbered properties. The parents, have paid their loan off years ago. And so they've worked really hard to get to the place where they are now. And they don't want to risk their kids, for whatever reason,
no, of course not.
screwing that up for them, which is, I completely understand. And the way that I explain it is that if we did set up the limited deed of guarantee, and if we did structure the loan for your children like this, essentially there would have to be non-payment on both loans for 9 months before the bank would actually take any action.
Okay.
And in my time as a broker, and I think as Dave's as well, we've never seen that happen. Generally, if the family's willing to offer this, they know the character of, the people that they're helping out, and, things are fine. But if for whatever reason that didn't go that way, then 9 months, the lender would then step in, try and foreclose on the property. It would be resold. In a perfect world, whatever debts were outstanding, so in Dave's example, the $400,000 and the $100,000 would be cleared, and the bank would be like, right, happy days, parents, here's your house, there's no further.
Harm done.
Yeah, correct. If that wasn't the case, say that there was still an outstanding amount of $20,000 after the children or applicant's property had been sold, the lender would then approach the guarantors, the parents, and say, okay, guys, there's $20,000 outstanding. How would you like to do this? Are we writing a cheque or are we selling your property? And they can come to some kind of negotiation on how to clear the remaining funds.
Okay, well that does sound pretty common sense. And I think in most scenarios, you would hope that no one would default on a loan within the first year, so that debt should be paid down anywho.
Yeah.
Okay, brilliant. Okay, our third and final topic, which we actually see quite a bit here in Canberra, the land of the public servant parents, are cash gifts. So what is a cash gift?
Cash gift is a non-repayable gift given to the children, applicant, so they can make the purchase of their first home.
Okay, so it really is the name it is what it is. It's a one-off gift.
Yep.
Yeah.
Yep. Not needed to be repaid. So non-repayable, non-refundable.
Okay, and is there any kind of agreement that the clients need to go in with the gift provider or?
So essentially what we ask for, if the client says to me, hey, Hope, my parents have given me $60,000 to buy my first home, I'm like, that's amazing. And I draft a templated letter stating clearly that this is a non-refundable gift.
Yeah.
And so the parents need to sign off on that. They need to sign off on the amount that they are gifting. And then we send that into the lender because we don't want the loan to settle and then the parents turn around and say, oh, actually,
give me some money.
Want that money back. And I want that it paid back at $1,000 a month, and that's just unreasonable for the the clients to do.
That would then be, I imagine, another commitment per se.
Correct. And that's why the lender is looking for that letter, because they want to know that they're not going to have to juggle paying the parents back along with paying the bank back.
Okay. And in terms of that letter, that's a good point, Hope, because I know that there's a few lenders now that this is becoming more common that actually need stat decks.
Yeah.
Just to confirm that the funds are non-refundable, non-repayable. It's getting pretty specific now.
It is. I think the lender just wants to ensure that they get their money back first. and
always the way.
And so they don't want the parents to risk or jeopardise the applicant or the client being able to pay their minimum monthly repayments.
Okay, beautiful. Well, cash gift seems like the easiest of the three. If you're lucky enough to have someone wanting to give you a large sum of money.
Bank of mum and dad.
Yeah, or inheritances, actually. We get a lot of inheritances lately. One thing I will mention, being that I work more on the kind of the settlement and the documentation side of things, is if you are getting a cash gift, please make sure it's available to you for you to buy at any point. It's rather redundant to have a cash gift made available to you 2 weeks after you've settled because you need that money before you can settle or you're going to be delaying kind of everyone, the sellers, yourselves, the moving companies, everyone. So essentially, in summary, the cash gift is just a true one-off gift with no commitment to repay it back to anyone. It has to be available to you, and your parents or the gift provider, per se, has to be willing to either sign a gift letter or a stat deck if required. Yep.
Correct.
Yep.
Beautiful. Okay, well, I think that kind of tees off the three alternate entryways that we see more commonly. Obviously, there's some other ones there, but dime a dozen.
I would say that's the main one. I did have a client win lotto once.
Oh.
But
unrelatable content.
100%.
Beautiful. Okay, well, thank you everyone who has tuned in today to listen to us talk about these three pathways. If you do have any questions at all or would like to kind of get the ball rolling and get a 3-month, 6-month, 12-month, 2-year plan in place to buy your first property, just get in touch. We'll put our details in the show notes.
Great.
Have a good one.
Thanks, Jess.
Thanks, Jess.
Cheerio.
See
you next week.
We acknowledge the traditional owners and custodians of the land this podcast is being recorded, the Ngunnawal people. We pay our respects to the elders of the Ngunnawal people, both past and present.